Well, good morning and welcome back to the Broadcast Retirement Network. I'm Jeff Snyder. This is BRN Weekly for Saturday, February 22nd, 2020. On Tuesday, I spoke with the Motley Fool's Dan Klein about some of those old gadgets that we have laying around the house and whether they're worth any money. Let's take a look.
The reality is, you could say, okay, an Atari 2600, oh my God, it has value. But they don't mean my Atari 2600, because my Atari 2600, which was a Hanukkah gift, I want to say 6th grade, but it might have been a year or two later. We opened it, my younger brother and I, so he would have been in 2nd grade, and we played Pac-Man for 36 straight hours. That's probably not entirely true. I doubt my parents allowed that, but it felt that way because it was absolutely revolutionary. So my mint condition Atari 2600 wasn't mint condition within 2 days of me owning it. And the same thing, I had a Commodore 64, but because my handwriting is so terrible, I used a Commodore 64 to do my homework when I was in junior high. Not that I did all that much homework. The same is true of any of these devices. Did I have a classic iPod? Yes. And part of the reason classic iPods are so valuable now is that people like the device and the interface, and they like that it's not a phone. So while you can absolutely buy standalone MP3 players, they tend to be on the cheaper side, whereas the iPod was a very solid device. So that's not just a collector's market. That's actually a market for people who have some money who miss Apple having a dedicated music device that was worth a few $100s, as opposed to now, most of the MP3 devices you buy, and I just had to buy one for a friend's daughter to use at school where she couldn't have a phone attached. And it was like fairly cheap because it's become kind of a commodity.
Dan,
so there's all sorts of reasons, but when you see, oh my God, if you have this, it's worth a ton. The reality is, it's if you have it in the sealed box, and why would you still have that for the most part? So I bumped into this a little bit when I did my book, Worst Ideas Ever, I don't know, 7 or 8 years ago. My original idea for the cover was to take the Apple Newton and have the handwritten title on the cover. And I thought, and I owned an Apple Newton back in the day, but when they were new and revolutionary, and it feels ridiculous because it's about 5 times the width, the thickness of an iPad, but at the time it was absolutely revolutionary. So I had to go buy one, and I paid maybe, I don't know, a couple $100 on eBay, and it said it worked, but it only worked when plugged in. So I couldn't get sort of it where I needed to based on the length of the power cord to try that as the cover. But I had to buy a lot of things in conjunction with that book that I wanted as images that were sort of, no longer existent. I had to buy a Furby. They make Furby again, but at the time so I paid way too much for a Furby. Or I own a classic XFL football, which XFL is back, but at the time that was a big failure. It was in the book Worst Ideas Ever. And a lot of those things, because there was just competition for it, for how silly it was, or in some cases, maybe it was limited edition. The exception on this list of things that are getting a high price is if you have a working Mac computer, you might get up to $1,000. And as someone who used a Mac computer in college, that is not nostalgia I have. The little 6-inch screen, and it takes you have to load a disk with Word on it. It is not an efficient computer. And the iPhone 1 is one of the products on this list that has some nostalgia value. And I would tell you as a consumer to be a little bit resistant to this. I understand nostalgia, but is it really worth taking $1,000 that you could invest or do something else with? I mean, take a vacation, or who knows what, and put it into something you're going to sit on a shelf, unless that's a centerpiece of your house or has some truly personal meaning to you. I think you should take advantage of this by looking up in your attic, looking in your closet. And if you have some things that have some value that are just cluttering up space from you, I don't care if you sell your old, iMac Cube for $25 on eBay just to get rid of it, because you can't even donate them anymore. But clear out your house. Like when we moved, and you and I have talked about this, I made the very tough decision. I gave away every book I've ever read. I literally owned 13,000 books. And I had decided my son is of the digital era, and he's not a reader. So these books were not going to be the family library that I thought they were going to be. because any book I owned, he could just pull up on his phone. Avoid fads. So I ran a toy store for 2 years, and we sort of ran away from selling expensive fads. Like we sold the rubber bracelets and things that were really cheap, but we didn't sell Beanie Babies at sort of the height of Beanie Babies being a collectible, because people weren't buying them for the reasons we thought you should be buying things in a toy store. We wanted you to buy a teddy bear because your 3-year-old was going to hug that teddy bear and bite its nose, not so you could put it in a attic and hope it's worth something someday. And let me tell you what, it isn't. So you have to be really, really careful with this stuff. And this isn't the 1980s where mom and dad threw away all the 1960s and 70s baseball cards, so there's a huge value for Babe Ruth. People knew to collect stuff. And the example I always give is when Maxim magazine came out, every member of my generation bought the first copy and put it away. So it's not valuable. It doesn't trade for any significant sum on eBay because a lot of people thought the same thing because we understood collecting. And I go back to the Star Wars figures. If you have mint Star Wars figures, if you have the original, the Emperor, you had to send in your proofs of purchase to get him, and he's still in the package, that might be worth some real money. My Han Solo that I chewed on is not worth any money because toys that are played with, and I would argue, even if you could get, say, $30 for a mint figure, that it's probably better for you to actually play with your R2-D2 than it is to, save it to collect it someday. And I have R2-D2 on my desk. My wife has the robot that treats Luke after he gets his hand cut off, just because I thought that was the funniest character that no one would know that she could possibly have. And I believe my son has IG-88, the destroyer droid on his desk, or the bounty hunter droid. So buy toys and play with them. Buy computers and use them. Don't speculatively save things.
On Wednesday, I sat down with 2 West Advisors Chief Investment Officer Vern Cushenberry to learn more about financial wellness and the evolution of managed accounts. Let's take a look.
Well, managed accounts are a tool in our quiver, I suppose you could say. It begins with your QDIA, starts with what is typically a target date fund. And then if you want a little bit more customization on a plan participant basis, you can move to a managed account. Most of the time in our industry, you're going to see advisors sit down one-on-one with a participant or use a questionnaire or wrap that with some piece of technology so they can customize that asset allocation a little bit for that retirement participant's goal. That's a broad definition of what a managed account is, but that's how we see it. Now, when we implement a managed account, we're usually packaging that with a piece of technology that's scalable across the whole plan. Our 10-year journey now, going on 10 years, has been 100% focused on creating better outcomes. And to do that, we know we need to serve as the QDIA, and we just can't do that without the right package of technology. And we hammer fees pretty hard. It's part of our culture and what we've been trained to do. And all of our IARs and partner advisory firms are familiar with the evidence that's coming out of Morningstar and 100 academic papers dating back to the 50s that shows just the small fee differential compounding over time. The math is powerful. So our belief is that we need to be in the bottom half or preferably the bottom quartile of fees as ranked by all target date solutions, which is why that technology package that supports those managed accounts is so crucial, because we just can't do it any other way. We have to be able to scale that and reach the participant in either an app-based or a financial wellness platform that they can come to know and understand and ultimately trust over time. The analogy I like to use is the Uber app. Participants have to be able to know where they are today, where they're going, and if there's a detour along the way, they need messaging that says, you're still on the fastest route. Don't worry. I grew up with grandparents. My kids grew up with grandparents. I believe it's a special time of life. There's a lot of wisdom in those years, and we want to help facilitate that goal. And it's really a belief in that goal that has driven us over the last 10 years. And we partnered with Dimensional Funds and Standard & Poor's and some other research heavyweights to do it. And we're just the practitioner that has delivered some of that into the market. largely based on Dr. Robert Merton's body of work that is life cycle finance, we know we have the ability to create better outcomes. And defined contribution as a system hasn't done it. The average participant at retirement has a balance of about $120,000. Mm-hmm. That'll create $5,000 in annual income in retirement, and that's getting nobody nowhere. So we know we need new solutions, and we've been putting those into the marketplace for going on a decade now. And that process has informed us that we need more than just good financial science. We need to address the behavior gap in a way that participants can understand, which is why now I'm out there preaching about wellness. You know, how do we meet the participant? How do we solve their needs? How do we get them to where they want to be? And that financial wellness journey started about 5 years ago, and we've been building the package of really the tech stack to facilitate that goal and creating a lifetime financial experience for the participant. My background's in finance and investing, and we are an advisory firm, but yes, more and more so we are merging into that world of fintech. And I tell people I feel like I'm in the world of fintech now, because what we do is to try to meet the participant where they are. And we've partnered with Questus is a financial wellness platform. We believe that they're one of the best in the business. They've built a customizable approach to reaching that participant, and that allows us to market test and revise and make changes over time as we see different marketing campaigns having a better effect. And ultimately what we want is something that can meet their participant across their financial world, because one of the first problems that we see is actually getting participants into the plan. And then once they're into the plan, we need a budget, we need proper insurance, and we just have ancillary needs. And if we're not addressing those, then we're going to lose the participant. And if we lose the participant, we're going to not be able to facilitate the outcome. So it has to work inside and outside the plan. It has to address ancillary concerns. And then the whole package has to be circular, meaning that it has to inform the asset allocation on the backside, which is not something that most participants want to get involved in, but it's crucial to having the right financial engineering when it comes to outcomes. 85% of sponsors say that they're interested in financial wellness, quote unquote, because it's the right thing to do. Then it's just a matter of which platform, what's the business model, how's it going to interface with our people, and who's bringing it to market. And the key differentiator there, and the direction that we're really pushing the industry in, is towards a fiduciary-minded wellness approach. I believe that it's really the advisor who should be the one bringing this to the sponsor and ultimately the participant, because they wear the fiduciary hat, and they're going to be able to oversee this from, I call it, from an outcomes perspective, so that we're not back to a mid-2000s type of approach where you have a lot of broker dealers inside of 401k plans in a commissionable model. Nothing wrong with that model, but you've seen the industry really move towards the fiduciary-minded approach, and we're anxious to see that applied at the wellness level.
And when we come back, buying a home in 2020 and avoiding that IRS audit. So stay tuned right here on BRN Weekly. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms? Especially for the smaller businesses. I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. and we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network. Welcome back. On Thursday, I sit down with Million Acres Matt Frankel to discuss buying a home in 2020. Let's take a look.
Well, the average mortgage rate is about 3.7% right now, but what most people don't realize is how much that can vary by credit score. You need about a score of 620 to get a conventional mortgage right now, and that's FICO score. But if you only have a 620, you're looking at an average of about 4.7%. Whereas if you're a top tier borrower, which is generally considered a 760 or above, you're looking at about 3.2. Over the course of a loan, that could make a six-figure difference in the amount of interest you pay. So yes, mortgage rates are at record lows, but there's a big gap between strong credit and low credit. And if you're in the lower credit tiers, it could be worth it to take a few months and really buckle down and work on your credit before you apply. There are a few things you can do to really boost your score in a hurry. The one that most financial planners give is paying down your debts, which obviously paying down your credit cards and loans and things like that is great, but it's not always practical for everybody. So if you have trouble paying down your debts, an alternative is to raise your available credit. This is kind of a credit hack that I always like to share. If you call your credit card companies and ask for higher limits, it has the same net effect of lowering your debt to credit ratio. So that can instantly boost your score by a few points. Another thing is just to let your accounts age. If you're thinking about closing an older credit card, don't do it. 15% of your FICO score comes from the length of your credit history. So just waiting a few months by itself can boost you by a few points. And so debt repayment, increase your available credit, and just let your credit report age are three really good ways you could have a meaningful impact in just a couple of months. FICO score is used by about 9 out of every 10 lenders. There's another, the distant second is called the Vantage score. They both have the same general framework, and FICO scores are produced by your credit information from all three major credit bureaus, TransUnion, Equifax, and Experian. Mortgage lenders take the middle one, so it's worth checking your all three of your credit scores. myfico.com is a really good place to start. To see what your lender's actually going to see, because a lot of credit cards come with a free credit score, but that's just one of the three, and you want to know what your middle is. And fees have come down considerably, especially if you look toward an online-based lender, more of a newer company, like say like a Rocket Mortgage or something like that. And a lot of these online-based banks are even waiving origination fees just to get mortgage business right now. So that kind of brings me to another really big point, which is to shop around. The FICO formula specifically lets you rate shop. It's common knowledge that if you apply for credit, it can hurt your credit score. Yeah. But with mortgages, if you apply for a number of mortgages within a 2-week shopping period, it's considered as just you applied for one. So shop around. You'd be surprised at the difference in interest rates you get offered, and even a seemingly small difference, say 0.1% in APR, can make a huge difference over the course of the loan. So shopping around is definitely worth doing, especially, and make sure you're looking at your APR, which is your annual percentage rate, instead of just the interest rate, because that includes the fees. I mentioned conventional loans, which is what most people use to buy houses. And there's more clear underwriting criteria, as in if you have a certain credit score, you need a certain number of months of expenses and reserves, you need a certain debt to income ratio. It's more of a broad picture, and if you're really weak in one area, you have to be really strong in the others, which is something that was really lacking in that 2008, 2009 timeframe. So they definitely they want to see cash reserves. They want to see enough income to justify the loans, which is the big difference between now and then. And they want to see that you meet all of their criteria, not just one or two, not just credit, but credit, income, employment history, and cash reserve, and your assets. So it's more of a broad picture that they use now than they did in the mid-2000s.
And yesterday, I sat down with the Motley Fool's Mari Backman to discuss the steps we can take to avoid an IRS audit. Let's take a look.
I do want to say something about being audited. In general, you don't want it to happen, but let's also be clear, it's not necessarily the scary thing you might imagine based on, TV shows or movies. It's pretty rare for an IRS agent to actually come knocking on your door, confiscating your documents. And, the agency just doesn't have the resources to send people to everyone's home, for a discrepancy of a few hundred or even a few $1,000s in tax reporting. So most of the time an audit really is just kind of a, mail-driven hassle. You get letters by mail, you respond by mail, and it's annoying, but it's still best to avoid getting audited. So yeah, we're just going to talk about a few ways to avoid having that happen. And the first and most important, report all of your income. So anyone who's salaried gets a W-2 from his or her employer at the end of the year, or rather at the start of the year, summarizing income from the previous year. That's something you need to file your taxes, and everyone pretty much knows you need to report what's on that form. What some people don't realize is when they get these 1099 forms in the mail, they may not realize what they are, they'll toss them out. That's actually income that you need to report. There's different types of 1099s. There's ones that you get from your bank or your brokerage account. You can get a 1099 if you worked on a freelance basis for a client. Any client who pays you $600 or more will send you a 1099 summarizing that income. For every 1099 you receive, the IRS gets a copy. So that if you decide to not report the $47 in interest you earned from your bank account, or the $300 in your brokerage account, or the $950 you made by, freelancing for, Sam's blogging company online, you're going to get yourself in trouble if you don't report that income. So keep those 1099s, report the income. A modest amount of tax you're going to pay on it it's worth paying to avoid that hassle. Actually, I know someone who I think one year just forgot to report, I think it was $29 in interest income. It was just an innocent mistake. This person was not trying to, pull a big fast one.
On $29, yeah.
Right. It's $29 in interest, which means what's the tax on that? What are you paying? $6. You owe the IRS $6, maybe $8. And had to deal with a hassle afterwards. So yeah, just be careful with those forms and just report. And a lot of banks and brokerages these days, they don't actually send it to you in the mail. You have to log onto your account and get it online. So that's something people want to be aware of too. If you don't have a physical copy sitting, in your folder, in your documents, log onto your account, make sure it's not available there, because chances are it is. So basically you have two choices on your taxes. You can take the standard deduction. It's a preset figure that the IRS dictates. It changes each year. Your filing status will dictate what your standard deduction looks like. If you have enough itemized deductions, meaning enough to exceed the standard deduction, it pays to itemize. But if you're going to itemize, you need to be careful. Namely, don't just guess at the deductions you're claiming.
Yeah.
And I think that's a mistake that some people make. So for example, you're allowed to take a deduction for medical expenses that exceed a certain amount of your income. And if you go ahead and claim an $8,000 medical deduction, what's the probability that your bills and receipts and expenses actually totaled such a clean number like $8,000? It could happen, but that's pretty rare. And when the IRS sees deductions that are almost too clean to be true, that could raise an eyebrow. The other thing with deductions, and the following sometimes can't be helped, but the other thing with deductions is that you want to make sure they're reasonably proportionate to your income. So that, for example, let's say you're self-employed and you're claiming a deduction for business expenses, which you're totally allowed to do. Any costs you incur in the course of doing business are deductible. But if you've got an income that you're reporting totaling, let's say, $60,000, and you're claiming $50,000 in deductions, that looks a little funny.
Yeah. How
can you afford to basically, if you're only earning $60,000, incur $50,000 worth of expenses? Now, listen, it can happen. It can happen if, for example, it's a year where you just maybe invested very heavily in equipment and whatnot, and let's say you had, maybe, just you're able to get by on savings, or you're just able to get by, so you were able to spend the bulk of your income on deductions. It can happen. But if you're claiming a large amount or a large number of deductions, or a large deduction proportionate to your income, just make sure you have very clear documentation backing that up, because chances are that there's a good chance that's going to get you return flagged. One thing I like to do, I know that physical receipts tend to either get lost or they can sort of degrade over time. So what I tend to do is every week, at the end of the week, I take any physical receipts that I have and I take a picture of it and I keep an electronic copy. So that way, if something does get lost, or, like you've got a receipt for something and, the ink starts to like fade over the course of, 5, 6, 7, 8 months. That way I just know that I have a record. Luckily these days, a lot of business expenses are recorded because you've got a credit card statement showing, what you bought, or you've got, a receipt via email. So a lot of that problem is kind of eliminated, but for any physical receipts, I always recommend just immediately take a picture of it and store it electronically.
That's a very smart comment. People do that. And our last one.
Yeah, and no, I mean those are my top 3 tips for avoiding an audit. Just again, report your income. Don't just guess at your deductions. Actually put those odd-looking numbers down. If your medical expense deduction is $7,962.29.5, you're better off putting that down than fudging it up to $8,000. And just make sure again that your deductions kind of are in line with what you earn, and if they're not, because like I said, there can be legitimate exceptions, just make sure your documentation is solid.
And that wraps up this episode of BRN Weekly. Hope you enjoyed it. I certainly did. But don't forget, we're not done for the week, because tomorrow we've got members of the media, academia, and financial services joining us on our BRN Sunday podcast to discuss all the news in retirement markets, technology, personal finance, and so much more. You're not going to want to miss it. So until then, I'm Jeff Snyder. Keep on saving, and don't forget, roll with the changes.